So Fed's going to announce their rate cut policy next week. The ECB is going to announce theirs this week. They're both likely cutting. As Powell said, the direction of travel is clear. What's not clear from the markets is how far we're going to go. I think that's a big question. We don't believe that the Fed needs to go as far as the market does, but we'll touch on that. What I won't touch on in any detail today is the debate tonight. The race is too close to call. Too much can happen between now and the election. It looks like it's going to be very close again, unless somebody really steps in it over the next 60 days. So I don't really want to spend a lot of time on that. We are hosting at ARS next Tuesday. Mark's going to put it in the chat, a invite to hear Andy LaPerriere from Piper Sandler Macro give his views of where he sees the election going and what some of the issues are. I was at an event last week where David Wasserman from the Cook Report, was highlighting how close he thinks it's going to be as an election, and pointed back to the last election where 3 states and 1,200 people decided the election for the country. This go around, 5% of the population will determine who controls the House. So it's going to be very tight. So all the prognostication about who's going to win, who's not going to win, it's going to be too close to call likely all the way through. So not going to focus on that. But the ECB is going to do their action. The Fed's going to do theirs. The Bank of Japan's going in a different direction, pushing rates up. But we are seeing calls for China now to get aggressive in monetary and fiscal action to address deflationary pressures that they're seeing. So we expect volatility to continue all the way through. Today, I just want to follow up on something I touched on last week, which is really sizing the global capital markets and putting that into perspective and some of the challenges with why you need to think about it have that perspective. I want to touch on the 25 or 50 for the Fed and what we think they're going to do, and then close up. So we talked last week about the size and scale of the U.S. Capital markets, and I wanted to put it in perspective. So you can see we're roughly now, this is as of last year on global GDP, you can see it was about $105 trillion economy projected to grow 3.3% this year. But it gives you a sense of how dominant the U.S. and China are in the overall scheme of things and how much they do matter and how much the U.S.-China relationship matters. When you get into the capital markets, the picture starts to change quite a bit. In fixed income, the U.S. dominates. We're roughly a third of the global market. I think it's hard to get the global bond market numbers, but it's just helpful to have the perspective because so much of how capital flows is driven through this area. And as we've seen in times of crisis, the U.S. as a safe haven becomes a much more attractive asset. And you saw that over the last couple of months in the fixed income side. But we have roughly, according to the IFF, or the Bank for International Settlements, the BIS, you have basically $141 trillion of debt in the world. You have a global stock market of about $115 trillion. The U.S., you can see, is the dominant player, and these are all the companies that as of last year, or countries that as of last year were over $1 trillion in stock market capitalization. And it just gives you a sense of how dominant the scale of the U.S. is relative to it. When you think about the Magnificent Seven being the second largest market cap in the world, or if you go to Apple or Microsoft, they would rank as the 5th of 6th largest market caps in the world. So it gives you some perspective on how dominant the size of the U.S. is and what that means for capital formation. You're also seeing a really interesting change going on right now for companies out of Europe that are looking to move their listings to the U.S. to do 2 things. One, have access to the broader capital market that the U.S. represents, but also they get a multiple re-rating as the valuations in Europe are lower than the US overall. And that shift is happening. And one of the companies that's been a hedge fund favorite and one we own called CRH, they're in the aggregate space, has been a kind of a symbol of this shift, where before their shift of listing, I think they're at a 12 multiple against MLM and Vulcan and those guys at a 21 multiple. So just making the shift over gives them an opportunity to increase valuation and also get more attractive exposure to the markets. But it is interesting when you see some of the changes. And I think from the time this was done to, I just Googled today where the China stock market cap is. I think it's down around $10 trillion right now. I thought it would have been a little bit lower. But you do see big swings in some of these economies as well, but it just gives you a sense of the scale. There's other elements that go into that, though, aside from the scale and the size being different. Trust and confidence is a big element of it. And what happened in China over the last couple of years with Alibaba and with the view towards some of the foreign companies is how confident can you be that you want to remain in that market? For US companies, it gets to be a little different than it does for European companies. I think in Germany right now, there's a real tension in the executive C-suite to determine how far you pull back or how aggressive you go towards China and what does that mean for you in the long term. I want to show you a chart in a minute on market concentration because it is actually quite scary when you get beyond the US. Because when you get into other markets, the liquidity and float really dynamics change because of structure of the markets, private ownership that's so dominant in public companies that you lose a lot of the float. And then the other issue is what is the belief of the rule of law in that market and how confident would you be as an investor putting other people's money into it as opposed to your own? So I think these are all issues that are out there, but this is where, with the stock market concentration, where we talk about the US and the FANGs, the Magnificent Seven, where we are a significant, the FANGs, I'll get the number for you in a minute, is a significant percentage of the US revenues, but it's nowhere near compared to what it is in other countries. And you just look at the size of it in other nations and you get a sense the US is not as overly concentrated as other areas are. And when you see for those other nations capital outflows, like you're seeing Volkswagen saying they're considering closing plants in Germany for the first time in their history, that's a reallocation of a lot of the German auto industry to the southeastern part of the US. That has big implications, not only for the stock market, but also for the overall economy, for jobs and labor and capital flows. So really interesting to see these dynamics. I think we talk about markets and don't really look under the covers as much as we should. When you get into India, the concentration isn't that high relative to other nations, but I think when you get into the float, it starts to change the picture considerably there as well. So I think you have to look at this a little differently than we have been when we talk about going into these areas when they're not that liquid and you have high concentration. What does that mean for your exposures and your risks? It's not necessarily, particularly if you're indexing, what do you buy? So switching gears to the Fed, and the big debate is how far and how much do they go? And every time thank God we're in a blackout period right now. It started on Friday, I believe, after the close of business on Friday. But every time a Fed speaker gave their views, the markets implied bigger cuts or lower cuts, and it was whipsawing the market around. I think the idea of as many cuts as the market thinks is going to be too aggressive for reasons that I'll get into in a second. But this is where the betting odds were as of Friday of last week. So pretty aggressive rate cuts coming, which would give you more confidence in equity valuations holding up or the Fed put being in place. But I think there's reasons that the Fed doesn't have to go that far. Q2 GDP was surprisingly strong. The latest revisions for the GDP now out of Atlanta showed it around 2.5%. So growth, but slowing growth, but still very strong growth for the US relative to other countries. I think our jobs report has been mixed, but not as bad as everyone thinks. I think some of that's weather related, but We are seeing new entrants come back into the labor force, which is help push up the unemployment rate, but that's because people are more confident that they can find jobs. So I think that's another element that isn't as bad as everyone thinks. I'm not sure. And then CPI is projected to hit, and PC are projected to move much closer to the Fed target, which is a positive. But when you combine unemployment rate and CPI, which is a number that people use to figure out, are we getting to recession? And I think this was David Kelly from JP Morgan was on Friday on CNBC and was highlighting this. I think he said that this number, where we are today, when the combination of where inflation is and where unemployment is lower than it's been 85% of the times in the post-World War II period. So these are not the conditions of excessively high unemployment and excessively high inflation that would create the conditions necessarily to require the Fed to be as aggressive as the market thinks. Now, obviously, the market's looking for multiple expansion, and they would get that if the Fed is doing 150 basis points of cuts, but is it necessary or not? I'm not sure. I don't believe it is. I think part of the concern in the U.S. is housing. It's one of the big issues, but is it a rate issue or is it a supply issue? Rates before the Fed has cut have come down over 100 basis points, almost 140 basis points already without the Fed making a cut. Housing is still improving, but still stuck in the mud because we have a supply issue that will be with us for some time. So I don't think that's going to solve it. So I don't think rate cuts solve the affordability issue. And I'm not sure some of the policies that are being thrown out would actually provide it for everyone, because if you looked at Harris's $25,000 credit, it would be for first-time home buyers whose families didn't previously own homes, which would narrow the field for who qualifies for that considerably, pushing it more towards minorities or recent immigrants, which is fine to do, but it doesn't solve the overall housing problem. So it is a good social policy. I don't think it's necessarily a great economic policy. So just wrapping up, because Mark, you have a lot to get through today. I think the markets are way too focused on single data points, and that's creating additional volatility. The election is as well. But I think you have to look back at the trends more to get a better sense of where we are than the market's excessive reaction on a number, whether it's the unemployment number, the next CPI number, the next PC number, whatever it is. Look at the trends more so than the data point. We are in a volatile period. It's not unusual. Between July and November, we typically see a 25% higher volatility. We had spikes that are well beyond that this time. There's a lot of talk about recessions, but a typical recession happens once every 7 years, or about 15% of the time. You've heard a lot from JP Morgan and Goldman Sachs talking about their calls on recessions, and Goldman's was quite interesting. They went from 15 to 20, then they jumped to 25, then they went back to 20. So are they really concerned about a recession at 20% odds when any year is 15? I think they're seeing some of the things we're seeing in the economy, which is good growth, not terrible unemployment, not high inflation trending in the right direction, real issues, real inequality issues. I'm not discounting any of the real problems that exist, but that gives us the sense the market's going to be disappointed over time about how much the Fed goes. And I think the Fed has to be careful sending too strong a message of 50 right now would be viewed politically as supportive of the administration. So I think they're concerned about that as well. This will be too tight an election to call. So all the people, getting all jammed up about where we are and what happens with the debate tonight, I don't think it will matter as much as you think. I think you have a long way to go before you can really get nervous. And I think there's real opportunities being created, but there'll be some more valuation created, I think, between now and the end of the year, because there's a lot of moving parts, and we didn't even get into the geopolitics, which is coming up next. But clearly, the Fed has to be thinking not only about their policies, but other countries' policies and what it will do to currencies. Because I think currencies is one of the areas where, if you want to see where real problems could pop up that could create the unanticipated event, we had it once with Japan. We're having a little bit of it again, maybe with the carry trade. I think distortions in currencies by the policies diverging, Japan increasing rates, the US lowering rates, Europe lowering rates, China lowering rates potentially, are all things that could create some distortions. So I think you want to take some time, don't overreact to things right now. If you have a good foundational view of where you want to be investing today, stick with it, adjust on the margins. But I think reacting to what's going on in the short term will lead you to the wrong outcomes. And I saw a good quote from Howard Marks where he said, in the real world, things go from, good to not so great. And in investing, they go from euphoria to, the end of the world. And I think we went through that period right now. And we look at the businesses that we own in the markets, they're not reacting the way the price action is. There's too much hype on certain areas like AI and all that, where we'll probably learn lessons that we learned the last go around with the tech bubble, that everyone doesn't win in this environment, that and that the hype train can get ahead of itself. And I think we're a bit in that mode right now. So I'm going to stop there, Mark, and move on to questions or comments or whatever you want to go through.
Great. Thank you, Stephen. Questions, comments?
Hi, both. Sorry, I couldn't get my mic to work, but I just want to say hi to Stephen and to Mark and to everyone. And I look forward to seeing you soon as well.
Thank you, Lisa. Lisa was an intern with ARS and is now in University of Durham in London. Will be seeing us at the London event. We're
And Irina, fellow Ukrainian, by the way. Thanks for that. Any questions on what Stephen just talked about?
Michael Hammer.
Mr. Hammer?
Sure. Stephen, you said, and I'm paraphrasing, that the debate really won't impact things. But there's always the real possibility of one or the other of the candidates, and I'm being a little bit flip here, pulling a Biden. That is, their performance is so dismal. Is it likely? Probably not, but is it possible? Sure.
Mm-hmm. I think Michael, the issue that I look at with that is if Harris gets sucked in, that would be bad for her. But so far, she's stayed away from getting pulled into what Trump's done to all the other candidates. And I think the Democrats have taken the view that if he ignores provocations, you're better off rather than taking the bait. So it'll be interesting to see that. It'll also be interesting to see if Trump can keep it together as well. But I don't know that the outcome will change their voting base much. And I don't think either one of them's done enough to capture the undecided voters yet. And I think that will be the next 60 days. So I agree, they could really step in it and blow themselves up. But I don't see what anything they've done so far would move them away from their bases that much. So I guess that would be the thing you'd look for is, do they say something that can attract the people that they haven't attracted yet?
And just on what should people expect from next week's talk with the political?
Andy will get into the debate and how they fared and how wrong I was on what I just said. Right. And then he'll also get into how talk a little bit about the races for the Senate and the House, because I think there's a large portion of the population that is that's the undecided that would be pleased with a divided government. And the map is very tricky for the Democrats on the Senate. And that would be one of the things that could change with the debate is how do they pull voters on down the ticket differently? And I think that would be one of the things to look at. But he will get into that quite a bit and some of the surprises that will come out of that's coming out of some of the state events. I think the big question, there's a lot of discussion right now, did Vice President Harris miss a big opportunity with her VP choice of reinforcing her base as opposed to going into an uncomfortable area with the guy who could be a rival in the next presidential election with Shapiro? And did they give up Pennsylvania or not? I think that's going to be one of the big question marks, and see how polling comes out of that state following the debate. It'll be interesting to see.
Well, similar questions about Trump.
Yeah,
But
but Trump's Trump.
Trump is Trump. Adam, Blanco.
Good morning, everyone. Stephen, thank you for the presentation. How impactful would a Harris administration or Trump administration be on the U.S. economy, given that it is so strong?
It depends on if they have control of the House or not, or in the Senate. If they sweep. I think the betting market odds on a Democratic sweep are, I think, under 20%. The Republican odds are around 40. I think that those odds are what I think would keep me up at night if either one gets too much. But I'd also point out that Trump learned from the last go round, and a lot of the proposals he's making, such as tariffs, don't require him to go through Congress. And he is more likely to act with that regard to Congress than I believe Vice President Harris would be. So I think that's one of the areas that you'd see some difference in. I think
Goldman said Harris would be better for the debate, didn't they?
they did, but you don't really know the policies yet. So
Exactly. In what context did they say?
I think they took the Trump tax cuts and tariffs and calculated them against her tax increases and other stimulus policies instead of more positive. But I don't know that they would cite either one of them as winning policies either.
Paul.
Hey, Stephen, thank you for everything. You mentioned housing briefly in your comments. I was looking at just this morning where rates were a year ago. Mortgage rates were about 7.75 October, September of last year. Now they're 6.25, and you haven't seen a significant increase in really housing sales because you would expect a decent bump given that 150 basis point drop in rates. Do you think that's going to be a persistent driver in maybe issues with GDP, that there's lack of new home purchases or home purchases because of all the purchases that go along with buying a house? And do you see, besides, you mentioned the prices that could still be driving it, you would think that, prices really haven't gone up in the last year in, let's say nationally, but, to any significant amount. Do you see that really showing weakness in the consumer? The fact that you've had that drop in rates, but not any significant increase in purchases?
I think it's more a reflection of a couple things. One is supply is the biggest issue, and supply where people are not, where there's not enough supply where the people are moving to right now, which is the Southeast and the Southwest. from the Northeast and California, basically. So I think that's one issue. I think there's another issue in the real estate market right now, which is the change in commissions have wreaked havoc on how the housing sale process works the way it used versus the way it used to work, where negotiating commissions is a big change and sellers and buyers are both involved in the negotiation process. And I have family that's working in real estate, and our family office that backs us has 7,000 or 8,000 agents in the United States. So I'm somewhat familiar, but I'm not close to that business. So I just give you the broad view is that commission change is a problem right now for sales. Supply is a big problem for sales. And I think the view of most of the heads of the residential real estate markets would be you'd see a change at a with a 5 handle in front of it as opposed to a 6. And that'll get them closer to the time that existing sellers would give up their mortgage and move into another mortgage. So I think those forces are all at play. And I think the goods issue that you raised would come along with that, but I think we've had such a supply and demand imbalance on goods that I think we're still working through that. So I'm not sure that it's the housing that's the primary driver of that. But longer term, we got to get our housing market back on track. Although I think the view that everyone should have a home was part of what got us in trouble with the great financial crisis. Because through most of our history, everyone didn't need to own a home. You needed to own a home if you could afford one. If you didn't, you figured out a way to live off rent. It created some of the inequality issues, but I think home ownership also created inequality issues from the great financial crisis. So I think there's a lot of cross currents in the housing market still that have to play out. So long answer to a complicated question.
Do you think rates will be in the 5 handle in the next 6 months? Is that kind of your kind of estimation? Do you see that as we have rate drops in the Fed funds rate, we can see a corresponding drop in the mortgage 30-year rate?
I don't know, because it's hard how far the banks are going to go right now to lower rates when they need to go low enough to get demand, but not too low to lose margins. So I think that's part of the problem they're having. But I also think you need to get a little bit more of a clearing mechanism where people are comfortable where rates are going to be. And I think there's too much uncertainty. Just alone our view versus the street's view of how many rate cuts are required to get the economy back on track, I think is a debate that's being held in a lot of places right now. So until you get a better sense of normalization, which is really, I think that's the thing we're going through, is the economy is getting back off of life support that it's been on, really going back to the tech bubble. We've had distorted interest rates that then were distorted even more after the great financial crisis, where we took them to zero, distorted even more by quantitative easing, and then distorted even more by massive fiscal stimulus. So we got to get back to normal economic cycles where you have things that get price clearance. And we really haven't had that for too long a period of time. So I think the normalization process is what we're struggling with, and we have to get back to. And it'll take time. It took a long time after the tech bubble to get things back to normal. It took time after the great financial crisis here. It took time for Europe to normalize. I think those things are processes we go through. Similar to the AI boom, you don't create a new technology and all of a sudden it's adopted. You create a new technology at the hype, and then you figure out the applications. And I think those are things that the market is too short-term oriented, and we have to get back to business cycles being more traditional.
Thanks, Stephen.
Other comments, questions? Alan.
The point that you made about the real estate and with what's going on there with the commission structure is a really interesting situation if you dig into it. We funded a lot of that litigation in Missouri where that took place. And if you take it apart with what's going on there is now the buyer's agent, the buyer has to pay the buyer's agent for that component. And what you're taking away is a lot of the purchasing power, especially on the lower end. If you think about that, if let's say, on $1 million property, $25,000 has to go to the buyer's agent. And typically, if you put 20% down, it's a material amount of money. And so the purchasing power is being taken away. And it's kind of a be careful what you wish for situation. I think it's going to be interesting to see how this materializes. What you're seeing right now is the sellers are putting seller credits, is what they call it, and shifting that into, and it's a game of cat and mouse, where because the sellers want to keep that structure, and the agents want to keep that structure the way it is, and so they're going to push that as long as possible. But with that being said, you are seeing people take material cuts and representing people for much, much lower amounts. And but the other hand of that, and the implication of this could be is if you hit into it too much, one, private equity will come in, there is a disallocation. They'll take advantage of the situation. The other thing is home prices will decrease and home values will decrease because what's been done in the past is the seller's agent paying both sides, it pushes up the price. They can actually roll that loan into, they can put that purchase, the buyer's fee into that purchase price and roll that into the loan. You can't do that now. And so there are a lot of different implications that go into it. And so, there will come a point to where it'll start impacting the overall value of the homes. And then that gets into taxes and other things and implications there. So it will be very interesting to see how this rolls out. I mean, if you think about it, what if there was a 1.5% or 2% decline in home values? And we go look at this Kansas City, Missouri right now. There's a really interesting case where they try to significantly increase home values from a tax assessor from the assessor's standpoint. And the schools and everybody rearranged their budgets. They try to increase it by 40%, 50% in some cases. And so the schools and everybody increased their budgets that way. And now the judges have come back and said, you can only, set it by X. And now people are, now they don't know how they're going to fund a lot of the different budgets that they'd already forecasted based upon that new assessment. So anyway, it is going to be, I'm talking on both sides here, but again, this was pushed by private equity. And I think that they, foreseeing a disallocation, you're going to see some interesting times here over the next, I'll call it, 12 to 18 months. It's going to be a game of chicken, and then things will, I think, slowly diminish and change. Anyway,
Yeah,
I'd love to hear.
I think you'll end up with a price with commissions coming down, but not coming down as much as everyone thinks, because if you're in a city and you have to deal with the co-op board, it's going to be very difficult for an individual to avoid a broker and not pay a commission, get their stuff through a co-op board or a condo board in New York or other cities. It is still the biggest investment most people make in their lifetimes. It's not one that most people are prepared to make on their own. So it's a question of how much the commissions come down. And I do know from the real estate side of the business, and I'm not talking from our own company, this is from talking to real estate agents and family members that are in the business right now. In their offices over the last month, they are struggling to figure out how to have the discussions with buyers and sellers about commissions. And that is slowing sales down. Paul, to your comment about not seeing the sales move, it's hard to figure out how to negotiate this right now because there is no roadmap for it. And they're trying to figure that out. So I think there are a lot of, there are factors beyond just the rates that are at play here.
Yeah, I'm seeing this. My wife did 30 million last year in sales. I'm seeing this firsthand. And so, yeah, it is really, really difficult. And it is definitely a different discussion.
And that said, I was out in California 2 weeks ago, and in LA, and the sales volumes there and activity is exceptionally high still. So where you'd think it would be not, and for big dollar homes, I mean, I'm talking about the mega mansions at Beverly Hills are still getting a lot of activity. So it speaks to the difference in buyers as well that we're seeing.
Other questions, comments? We're going to switch soon to geopolitics.
Argument. One just last thing on housing. I think this inequality issue and housing affordability is probably the top of mind thing for most people. I would say 35 and under as a voting issue. I think their view of who will make things more affordable for them is a real issue in the election, and I think the housing component of it is going to be a big part of how people vote. And I don't know that either one's come out with policies that would sway you one way or the other, but I think the perception is going to drive the reality there.